Hey, welcome back everyone to the Midtown View. I'm your host, Jim Wenk. And today with me, I have a very special host, back again by popular demand, Matthew Schreck, Director of Tri-State Research for Savills. Welcome back, Matt.
Thanks, Jim. It's great to be back. Happy to be here.
Yeah, so we met up 3 months ago. It was, I guess, early April at the end of Q1 to review leasing and activity in the market. And I know we had another robust quarter, and looking forward to getting your insights into what's transpired and what we could look forward to as we get to the second half of the year.
Yeah, it was another interesting quarter. It's almost hard to know where to start talking about it, but I feel like I tend to start with leasing activity as a proxy for demand, right? Demand sort of leads the conversation. And last quarter was pretty momentous because we had more than 12 million square feet of leasing volume in Q1, which was a huge figure. In Q2, we backed off of that a little bit. Our figure came in at 8.8 million square feet, still slightly up from the previous Q2 last year, and still contributing to a first half total of 21.1 million square feet, which was the highest first half total since, I believe, 2014, so over a decade. So the recovery from an office leasing demand perspective is really back in Manhattan in full force in a way that it is not necessarily back in other major metros across the US. Manhattan's really leading the way. And despite the fact, like I said, that the level of activity did moderate due, I would say, mostly just to a lack of really large deals. We had a lot of big 100K plus leases signed in Q1, and there were less of those this quarter, which contributed to the drop off, but still on the track of recovery as we head into the second half of this year.
So over 20 million square feet leased, the most since 2014. Yep. That's a huge sign, huge positive sign for this marketplace. And I'd love to get a little bit more into the weeds on like the breakdown of industry sector and kind of what's driving the demand. Because, yeah. I mean, we've talked about this, I know previously, that, leading up to, call it the pandemic in 2017 through 2020, one of the big growth drivers in our market was flex space, right? So we had, besides everything else being pretty robust, finance, legal, tech, flex space. Yeah. And that has completely reorganized itself. It's still here to stay, very much so. But we have some new kind of industry paradigms, entering the market over the last 12 to 24 months. So just would love your insights into, we know our marketplace is very much driven by finance and legal, healthcare is always around, but I think we talked about it back in April, the entrance of AI in a very big way, and some others that are, the other industries that are growing as well. So we'd love your insight there.
Well, I think, it goes without saying. I mean, you already said, finance and legal are huge parts of the New York marketplace. They're oversized in this market relative to most other markets, and that's been a key cause of why leasing has returned to greater strength and with more quickness than in other markets, and that continues to be the case. Financial services, that industry led the way in leasing volume. Once again, as it does almost every single quarter, accounted for more than 30% of leasing volume. Legal also, we continue to see activity, but there's been more activity in the tech, or the technology, advertising, media information, the TAMI sector, as we call it. Amazon especially, they signed a 330,000 square foot lease at 452 Fifth Avenue, right off Bryant Park. And then it wasn't even recorded in our leasing stats since it wasn't a lease, but they also bought the entirety of 522 Fifth Avenue to occupy. So that's a 600,000 square foot building right there, coming off the market to be occupied by a huge tech user. And then if you sort of look beyond FANG and the big tech companies, into the smaller, mid-sized firms that tend to kind of operate in Midtown South and their boutique spaces. That's a part of the market where we saw a drop-off in activity, as I'm sure you saw as well from a boots on the ground perspective, right? Over the past couple of years where funding sources kind of dried up, there wasn't a whole lot of activity, a little bit of trepidation and uncertainty around, how much time are we going to spend in the office? Do we need an office? As that conversation has sort of resolved, and the consensus is that, for the most part, people are going to have an office. It's going to be used at least, sort of on a hybrid type schedule. There's been more activity. Funding has come back a little bit, and we've seen more activity, especially in Midtown South and especially in, the areas around the Flatiron District, Union Square, Park Avenue South, more on the east side of Midtown South. Nice buildings with good access to multiple subway lines near the parks. There's been a definite uptick in activity among those types of tenants in those types of buildings.
Amazing. So, and we know just from deals, within Savills and our team and others pending in the market, there are some marquee projects that are slated to close in Q3.
Yeah.
So I think, hopefully we're on track, to continue the momentum into the second half of the year. But I think knowing that the private equity and VC funding is there in a very significant way, there seems to be a lot of backing in AI and tech, which we hadn't seen for probably 2.5, 3 years, right?
Yeah.
Coming out of the pandemic. And what I could say unequivocally is that prospects we're talking to, even in the younger stage, they're in the office 4 to 5 days a week.
Yeah.
I mean, this is a complete 180 from 4 or 5 years ago.
That's the impression, I've gotten through conversations with others too, is that especially for growth stage type companies like that, there's an emphasis on being together. And the data that we're looking at is typically based on, finalized transactions. It's a little bit backward looking in a way, things that have completed, but we do also have sources of information, in terms of who is out in the market and where, potential leases are being negotiated. And to your point, it feels like the activity that we've seen in the tech space, specifically in the AI space so far this year, is really just a taste of what may be to come in the second half of the year. I mean, rumors abound, right, of AI firms who have made prior space commitments and are now turning around and saying, wait, this isn't enough, we need more, and they're back in the market.
Yeah, it's great news. I think the other kind of overarching theme is, the supply and demand, or really the supply of the inventory. So you have inventory, the older stock that is slowly coming offline, the antiquated, that's slated for residential conversion, and there's probably not as much as we all want to happen. There's some challenges around that, just politically, financially, et cetera. But it is happening.
Oh, it's happening.
It's happening. So you kind of have this older, outdated buildings and stock coming offline, 1 million square feet at a time, and then you have the lack of new development rushing online. I mean, there is new development in the pipeline, but certainly not enough to keep up with demand. Yeah. I think this past quarter we saw the commitment by Deloitte, right, that they're going to be anchoring 70 Hudson Yards, I believe it is.
Yeah, and that's one that wasn't even included in our stats. So I know I mentioned the 8.8 figure, doesn't even include Deloitte's 800,000 square foot, from what we understand, nearly finalized handshake commitment to that building, just because, we weren't tracking it as a fully finalized, formally executed lease, but still, it's activity that's known to be there, right? And that's a huge one. But your point about shrinking supply due to a couple different factors amid this resurgent demand, especially in the high-end market, but even beyond the high-end market, in sort of the upper, nicer Class B market, is definitely a trend we're going to continue to watch, because if you break it down to the simplest terms, right, we're at a point right now in this moment where we've got shrinking supply and growing demand, and we know what happens when those two forces intersect.
Yep.
So in analyzing the data, it was pretty profound to see our inventory of competitive leasable office space that we track shrunk more than 7 million square feet on the quarter alone. And that was conversions, projects moving through the conversion pipeline to the point where we felt comfortable taking them out of our inventory. So think of buildings along 3rd Avenue, 1740 Broadway, 5 Times Square we took out last quarter, but that's another great example of office to residential conversions that are progressing through that pipeline. But then there's examples of other buildings that have been acquired by owners with the intent to use. We talked about 522 Fifth Avenue. 2 Park Avenue is another example of a building that was sold to a user who our understanding is plans to occupy not the entire building, but most of it.
Right.
So you have all these forces taking space out of inventory, and then the demand is resurgent, but it's also concentrated in not only the high end, but sort of the upper end of Class B, especially with strong locations and good credit quality landlords. So that interplay is going to pressure availability rates downward and most likely pressure rents.
Yeah, I mean we're seeing obviously in these pockets that there's multiple bids going on. There's tenants getting bumped. I think one prime example is even along 6th Avenue. I know BlackRock acquired a business at 1345 Avenue of the Americas, Global Infrastructure Partners, and they had 2 floors in that building. And so their BlackRock is going to move that group over to Hudson Yards, and right away those floors were leased to Paul Weiss. They expanded in the building and took another 80,000 square feet, 90,000 feet. So that's finance and legal intersecting right there in one building. Yeah. But we're also seeing in another 6th Avenue building at 1271 A of A, Mizuho expanded. There's no more space in that building available. It's fully leased, and they expanded into 1285 Avenue of the Americas. They took a sublease from UBS, and I don't know if that was first quarter, second quarter, but anyway, you're just seeing that finance and legal is expanding, and then you have the VC and private equity backed tech companies and new businesses popping up, coming out of spinning out of WeWork or Convene or some of the shared space providers. So very dynamic market right now.
It is. Yeah, very dynamic market. A lot of interplay between industries and in some cases, like you mentioned, a little bit of musical chairs when it comes to spaces. We did definitely see a lot of activity along 6th Avenue, and the availability rate along that corridor in Midtown of 6th, I think, is down to about 11% right now. So getting close to the single-digit mark with consistent, pressure downwards. So we're seeing things move in that direction. Yeah.
So I think it's always difficult for businesses to forecast where they're going to be with their headcount, with their revenue. But I think the more that they could think about getting in front of their anticipated requirements, the better, because it's just the options, the available options could change very fast, and dwindle. Yeah. For the prime locations and the prime spaces.
It does seem that way, and from my perspective, just looking at the way the market is moving from a data standpoint, it seems like it would be prudent in most cases to at least look at your situation and think, where am I going to want to be, 6, 12, 18 months from now? Because it feels, with the way the data is moving, that we're getting to a point where we're going to see an acceleration in rent growth in certain more in-demand pockets of the market, and a further tightening of availability for all the reasons we mentioned. So, I think it would make sense if you're an office user and you have an expiration date or some sort of date coming up where you need to take an action, to at least assess your situation before things get, I don't want to say out of control, but
Too frothy.
too frothy.
Yeah. Well, I think the other notable point in our market is, I just read about a refi at 300 Park with Tishman Speyer. And I think if there's easing in the capital markets and there's more, I would say, confidence in office rent growth and office demand, we should start seeing some of these loans being refied, with new long-term capital and maybe some new capital coming in for some of the buildings that need some investment. But I don't know if you have a view on that or it's just we got to wait and see. But I think that was just something I read recently, and hopefully, with more money flowing in, that's just good news for everybody, the lenders, the sponsors, and owners alike.
Yeah, well, we've been in this environment for years now, right? Everybody's come up with a new phrase for each year for the whole extend and pretend strategy, right? Like try to get to the finish line where valuations recover and it becomes easier to refinance some of these loans and work out the debt situations. And it's just been owners trying to white knuckle it to that proverbial finish line. But maybe we are getting back to an environment where that is within reach. Looking at some of the capital markets data, we can see in recent quarters that valuation declines have been flattening out. So in that sense, it seems as though a base may be being set on values off of which to grow, especially if there's more rent growth, there's greater occupancy. So I certainly can't sit here and say, we're in an environment where values are rising and things are taking off, but stability seems to be taking hold at the very least, which could lead the way to that.
Well, I think it's like the money's going to follow, the tenant demand. So if there's the tenant demand's there, the occupancy's there, the vacancy's going down, there's projected rent growth, and even though interest rates haven't dropped, to where everyone wants them to be,
right.
I think, when you look at where you could place your money, there's going to be the slice of the market that gets back into office. And there's, I think New York City office is going to benefit more than anyone, any other city right now, just because of the nature of our demand.
Yeah, I tend to agree, especially with the fact that New York is really set apart from other markets right now. So we seem to be getting to that point. The capital markets team would probably cautious me not to be too optimistic.
Yeah, I mean we see a couple again you have some end users, tenant end users that made purchases, right? And so that's kind of a newer phenomenon. And then you had a couple refis out there. So we'll see. I think that's something I think we have to look at the second half of the year.
Yeah.
Right.
And there's always going to be winners and losers too. It feels like this has always been true. In real estate, location is everything, right? That's always been the case. But it feels more true than ever. Where there are going to be winners and there will be some losers. But if you're in a well-trafficked corridor, if you're in a neighborhood or a submarket where people want to be, where it's easy to get to work, where the quality of buildings is good, where you're surrounded by, as a user, your clients and competitors, then a rising tide will lift those boats.
Yeah. Well, look, there is a lot happening for the middle of summer, post 4th of July. And, brokers are busy, owners are busy, tenants are thinking about their plans, not just, waiting till after Labor Day, at least the ones that we're talking to. So I think that's true across the board. It's going to be, knock on wood, a robust second half. But as we do with all of our guests, and we did last time, we got our crystal ball. Kind of want to know what you're seeing out there as we turn into Q3.
Yeah, I had a little bit of time to think about this, and I feel like there's different directions we can go. But one thing we didn't talk about yet here is the sublease market.
Oh yeah,
really.
That's
And sublease space, it was frankly unbelievable, the amount of space that came online after COVID, and how the market was really just drowning in sublet options from firms who really didn't know what the future of their space needs would be. So it was just sort of like, we're not in the office right now, let's put it on the market. And gradually over time, that wave has crested, and we've seen sustained and significant declines in the amount of sublet space available on the market, which is good, because as that recedes, it's really a sign of a healthier marketplace.
Definitely.
So just some stats here. The total amount of available sublet space in Manhattan is down more than 30% year over year. Really staggering. I believe the level is around 14.3 million square feet. The peak was above 20. So we're talking nearly 6 million square feet taken off through a combination of subleases, some of its terminations, term expirations and space rolling back to the landlord, and more recently, companies deciding, actually, we want to reoccupy and use this.
Yes.
So we're going to get back in there. There's been a lot of that in recent years, especially. So the amount of space has really come down. And the interesting thing about sublet space is it was already on the rise pre-COVID. So the pre-COVID level was 13.7 million square feet. We're at 14.3 now. So my prediction is before the end of this year, we are going to get back below that pre-pandemic level of sublet available space, which is going to be a good sign for stability and predictability in the office marketplace.
That's great. That's great. That's like a good key barometer of where we are. Matt, that's great insight. And as always, really appreciate it. Appreciate your time. You got great, you got a great view into what's happening real time from a lot of different data sources. But looking forward to having you back in early October.
I am too. Right? 3 months, start the clock.
Yep. And we're looking forward to some great insight then.
Really appreciate it, Jim.
Appreciate it.
Thanks for having me.
Thank you again.
Thanks.
That's great. Thanks everyone for joining another great episode of the Midtown View. I'm Jim Wenk, and look forward to seeing you next time. Thank you.